Okay, I'm back. So now we're going to talk about brokerage accounts. So right around this time in the course, students usually come up to me and say, okay, I get it. We're going to buy 100% stock portfolio. We're going to diversify. We're going to use ETFs. But how do we actually do it? Now, many of you have already started to do this because I'm getting emails from you guys every day, which is fantastic. For those of you that haven't done it yet, let's talk about how you actually start physically investing. Okay? What you want to do is open self-directed brokerage accounts. Okay? Brokerage accounts, or let's start with what a brokerage is. In Canada, brokers have the legal right and privilege to actually trade securities. It's brokers who are allowed to buy and sell stocks, bonds, ETFs, mutual funds, stuff like this. Okay? We don't actually have that right. So even though in class we talk about, I bought shares, of this ETF, or I bought some mutual fund units today. We say that, but in truth, we didn't. We asked our broker to, and our broker did it for us, okay? So we need to open accounts at our brokerage and put money in those accounts and then get the broker to invest for us. We tell the broker what to do. That's this piece, the self-directed piece. We tell the brokers what we want to buy and they will do it for us. But it's the brokers actually doing the trade, okay? Now, for most people and for you guys, there's mainly 3 accounts you're going to use throughout your life. You're going to open an RSP, a tax-free savings account, and possibly what they call a taxable account or a cash account, or sometimes they call it a margin account. Okay, we know what RSPs are. We know what TFSAs are. The other accounts, the taxable or cash or margin, depending what they call it at your particular broker, can invest in the exact same things, only you get no tax sheltering. So all the income you make on a yearly basis, you have to pay tax on, okay? And if you remember from last week's lecture, if you're going to use taxable accounts, meaning not RSPs, not TFSAs, please, please, please don't buy mutual funds in those accounts because the tax consequences are terrible, okay? Now, most people have brokerage accounts like TFSAs and RSPs and stuff at the brokerage associated with their bank. So for example, I bank at TD. I have my accounts at TD Waterhouse. I don't have to. I do, but I certainly don't have to. And you can see RBC has a broker, Scotia has a broker, CIBC has a broker, and BMO. So all the big banks have their own brokers, okay? And most people just find it easy and convenient to open a RSP and TFSA at the broker affiliated with their bank. Why? Because you've got all your money sort of under one umbrella, right? I've got all my money at TD, so to speak, and moving money from my TD bank account to my TD broker is instantaneous. It literally happens as fast as I can click a mouse button, okay? However, the disadvantage is these brokers, because they're affiliated with banks and banks like to make money, charge you the highest fees. So you get lots of convenience, but you pay a little bit more for that privilege, okay? For example, I said in the last lecture, I pay $9.99 every time I make a trade, okay? Every time I buy or sell an ETF, I pay $9.99, all right? Not the end of the world, but still. Now, in the last lecture, I said there's a couple of options these days where you can open up accounts at a broker and pay way less in fees. That first option is Questrade. You can open an RSP here at Questrade, a tax-free savings account at Questrade, or a margin or cash account if you want to as well. And they charge you no dollars to buy ETFs, and currently they charge $5 to sell. And again, I wouldn't let the $5 to sell stop you from using Questrade, because we shouldn't be selling much anyway for the next 40 years, right? We should just be buying. The other option, which I mentioned last week, that I don't have in these slides, is Wealthsimple. Again, I haven't had enough time to explore it to say whether I like it or not, but if you want another option to consider, investigate Wealthsimple And the key there is to make sure you can do self-directed, meaning you make the choices. Okay, you make the choices. Questrade is definitely self-directed, which is why I like it. But you could look into Wealthsimple as well. Okay, now the thing that's cool about Questrade is their marketing is fantastic, just fantastic. I don't study marketing. I've never studied marketing. I know there's some Moss students in this class that maybe are listening to my voice right now who are in consumer behavior. Watch these commercials. Everybody watch these commercials, but especially you students studying consumer behavior. These commercials are awesome. And they just are taking a shot at the big brokers like TD Waterhouse and BMO InvestorLine and stuff, because Questrade's fees are so low, and they're really playing on that because it's a good thing, because you get to keep more of your money. So watch those commercials. They're hilarious. I absolutely love them. Okay, this is a GIF that's not working. This guy's supposed to be saying burn right now, because in these commercials, Questrade is just smoking the brokerage industry. It's awesome. Okay, so, all right. So how do you use your brokerage account? It's as simple as opening up a TFSA, an RSP, or a cash trading whatever account. This maybe, you know what, should say and, maybe open all three. Okay, so open them up. You can open them up at Questrade or TD Waterhouse or anywhere you feel like. You will link that brokerage account to your bank account. Really simple to do. When you're opening the account, they will simply say, where's your bank account? And you'll say, my bank account's at Royal Bank. They'll ask for the account number. They'll link your two accounts together, which makes transferring money back and forth very easy. Okay, so really simple process to do. Once the accounts are open and your bank account is linked, you simply transfer money. So you transfer money from your bank to your RRSP, TFSA, etc. Okay, now, if you, like me, bank at TD, say, for example, and use TD Waterhouse, the transfer of money from my TD bank account to my TD RSP is instantaneous. If I'm going to use Questrade and I'm going to transfer money from TD to Questrade, it could take 1 or 2 business days. So if you try to transfer money on a Friday, say, it'll hopefully show up on Monday, something like that. So it won't be instantaneous, but it won't take too long. Okay? Now, once the money is in your RRSP, or once the money is in your TFSA, you have now made a contribution. We would say you have now made an RRSP contribution and you get a tax deduction. Or we would say you have made a tax-free savings account contribution. Why does this matter? Because we have to remember there's limits to how much you can put into each of these accounts, right? And we've talked about that before. So you can't just put money in, pull it out, put it in, pull it out like a bank account, right? Because we know your RSP room will be lost forever. Your TFSA room will be lost for 1 year. You can put it back the next year. So if you're going to put money into these accounts, please only put in money that you don't need for at least 5 years, if not longer. For your RSPs, you don't need it for decades, right? Because we're never pulling money out of our RSPs. So when you're getting ready to open these accounts and put money in, don't experiment, don't play around. Get serious and say, I have this much money, even if it's $100 to start, even if it's $50 to start, that I'm going to put into this account and I'm going to begin investing, and I'm not going to touch this money. Same with your TFSA. Yes, you can pull money out of your TFSA and put it back the next year, but you're losing the compounding. And remember what happens if you lose the best 10 days in the market? Don't pull the money out. Leave it. Just leave it. Okay, so when you put money in there, I want you to pretend that money's gone. All right, so you put the money, transfer it from your bank into one of these accounts. Then you log into that account. And in class right now, I would be showing you how to do this. I can't do it right now in this video for privacy reasons. It's impossible. I can't do it. I would literally log into my TD account right now and show you, but it's really simple to do. If you can do online banking, you can do this. So you log into your account and you just find the button that says buy, and you pick the ETF, mutual fund, stock, whatever it is you want to buy. And with a few clicks of your mouse, you simply use the cash in your RSP to buy shares of an ETF or units of a mutual fund or whatever the case may be. And you're done. You've invested. You've put the money in. You've bought, an investment with that cash, and now you just start waiting. and next month you put more money in and you do it again. Okay, so right here I would show you how to do it online. I'm sorry, I can't do it on this video. Okay, trust me, it's simple. Now listen, all of the brokers, even like Questrade and stuff, have phone numbers where you can call and you can say, I have never put money into an account before. Can you walk me through how to do this? I have never purchased a share of an ETF before. Can you help me do this? And they will walk you through it on the phone. They're happy to help. You can call them 10 times if you need them to teach you how to do it 10 times. But once you learn it once or twice, it's such a piece of cake. You'll be doing it no problem after that. Okay, good. So that was brokerage accounts. Now, I know I'm jumping all over the place, but we have a lot of, that's why I call this lecture odds and ends. We're going to talk about a lot of different things. Okay, next I want to talk about target date funds. And the reason is these are becoming really popular. I think target date funds are now the most popular investment in US 401k plans, which is like work pension plans. Super popular. So you're going to come across these, you're going to read about them in blogs or whatever. So I want to talk about what they are, and that way you can decide if you want to use them. Okay? So target date funds, they're also sometimes called life cycle funds, dynamic risk funds, or age-based funds, okay, is a collective investment scheme that's often a mutual fund that will invest for you, and they, meaning the people that run the target date fund, will choose your asset allocation for you and then change it over time. And notice the mix becomes more conservative as the target date, which is usually retirement, gets closer. So let's look at an example. This is just a graph. It doesn't represent any particular target date fund, but this is how it might work. Okay, so first I want you to see on this graph, here's the target date. Okay, and then we go all the way back 45 years. These are years on the bottom, okay? So I want you to pretend you're 20 and you started working at a company, and the company has a pension plan, and you're going to put money in every paycheck, and the employer is going to put money in every paycheck, and you have to decide what investment to pick, okay? We call this a defined contribution pension plan, just like it is at Western. Every month I put money in, Western puts money in, and I choose what kind of investment I want to buy. Now, here's the thing with pension plans. You can't buy anything you want. The pension plan will have a set list of investments to choose from, and you just have to pick from those choices. That's it. Okay, that's it. Which is why, back to those companies suing their employers, the employee said, the options you gave us in our pension plans suck and the fees are high, so we're going to sue you. Okay, so let's say you're 20, you start working at a company, they have a pension plan, and they put the list of investments down in front of you, and you see that one of the investment options is this thing called the target date fund. Okay, and you see that this particular target date fund is the 2065 target date fund, meaning the date that you are targeting is 45 years from today, 2065, okay? So you're going to start investing, and every time you put money in, the people running the fund will buy for you, in this example, 85% stocks and 15% bonds. How nice of them, okay? And then as time goes on, as you get 5 years older, notice the amount of bonds that you get is going up, and the amount of stocks that you're investing in is going down, and it keeps going up, and stocks keep going down, which is why they say it gets more conservative as you get closer to the target date. What's the target date? Retirement. Okay, and notice once you start getting really close to retirement, they start putting money market, which is like basically a low interest cash type thing. It's like a savings account basically with a little bit of interest. So they start putting that in there. I bet you can already tell what I'm going to say. I hate this, right? Because even if you retire at age 65, many of you will live for 30 or 40 years beyond that, and if trends continue, maybe even more. So why do I want this many bonds in my portfolio when I still have 30 or 40 years left to invest? And why do I want this much cash? I don't. But remember, the traditional thinking has always been as you get close to retirement, you've got to smooth out the roller coaster. You've got to smooth out the roller coaster because it's dangerous to have too much money in the stock market. I just made air quotes, you couldn't see them. Well, we're going to talk about that next week, but I want you to remember this, okay? That's hilarious. Next week. Next video. We're going to talk about that next video, okay? In what would have been our last class. So remember this, target date funds will put bonds in your portfolio probably before you want them and give you more than you probably will ever want, and you have no choice. And for the stocks, what stocks are you buying for me? Well, they're going to buy index funds, but you can't choose which ones. You can't choose how much Canada. You can't choose how much US. You can't choose how much emerging markets. There probably isn't any emerging markets. You can't choose small versus medium versus large, and you can't choose growth versus value. You choose nothing. They buy the bonds they want, the stocks they want, and you're stuck with it. Okay? So I hate these things. A lot of people love them because, they're managed and they figure that this kind of investment's better than nothing, and most people have no idea what to do, so they're like, great, I'll just do this. And most people think, oh, less risk at retirement sounds good to me. It's not good, and I'm going to show you why in the next lecture. Okay, so this is better than nothing, but for you, this is not what I want you to do. We're going to go stocks, way more than this, right up until the day you die, so you can leave huge amounts of money to charity or your heirs or both or whatever the case may be. Okay, that's my opinion anyway. All right. Okay, next, robo-advisors. So what's a robo-advisor? These have been pretty popular the last 10 years or so. And Wealthsimple is probably the best known robo-advisor right now. Robo-advisors are basically online advisors that will take your money and invest it for you. And it will invest it for you based on how you answer your risk profile questionnaire. Remember, we saw one of those in class. So if you answer the questionnaire online and you come out as a moderate risk investment, they will put you in a moderate risk portfolio, something like 60% stocks, 40% bonds, maybe 50-50, something like that. If you come out as a low risk investor, they will put you in 30% stocks, 70% bonds. And if you come out as like the highest risk, they'll probably put you in 80% stock, 20% bonds, no matter how old you are. So if you're 19 and you fill that thing out as a high risk investor, they will give you 20% bonds. And we don't want 20% bonds when we're 19 or 29 or 39 or maybe even 49. We might not want 20% bonds. So robo-advisors will invest for you. They're going to invest in index funds. Okay, so that's pretty good. But again, you don't get to choose. So what are the advantages? Well, the fees are pretty low. Last lecture, we talked about advisors charging you 1 to 1.25% to manage your money. That adds up to millions of dollars over your life of lost portfolio growth. So robo-advisors are way cheaper than that. That's what robo-advisors are good at, not charging much money. Okay? They supposedly have all this fancy software running behind the scenes that are really good at putting portfolios together for you. I got to be careful how I say this because I don't want to get sued by any robo-advisors. I think that's nonsense. I've seen portfolios that robo-advisors have put together, and there is nothing fancy about them at all. At all. I don't even think they're very good. They have like way too much Canada, for example. Way too much Canada, way too many bonds. They don't have enough small. They don't have enough value. I don't like their portfolios at all. But most people off the street have no idea how to evaluate a portfolio. They don't understand small versus medium versus large. They don't understand value versus growth. And they don't understand why it doesn't make sense to have a lot of money in Canada. So the robo-advisor seems smart, right? And listen, if people have no idea how to invest, then heck, a robo-advisor is better than nothing. But I think, again, for you guys, I would rather you control your investment choices, okay? Another advantage, low minimum account balance. I mean, you could start off with like $100 or something and just get going, and they'll start managing your money for you. So that's great. So in truth, if people are never going to take the chance, or the time rather, to learn how to invest, then using a robo-advisor is probably a pretty good option. You can start with a little bit of money. They're going to invest your money better than an average person probably would. and you don't have to worry about it. And the truth is, if you are starting out with a little bit of money, which most people are, right? When they start investing, you don't have much. The good investment advisors, like the really good ones, are never going to talk to you, because the really good investment advisors probably have account minimums of like $1 million, because they don't have time to help you with your $500 investment. They just literally don't have time. They're dealing with super rich clients. So robo-advisors at least don't have that barrier to entry, and they will help anybody. So that is a good thing. On the downside, they pick your asset mix for you. So again, they're going to give you bonds before you want them. Way too many bonds, in my opinion. Plus, you can't necessarily buy a bunch of small or a lot of value positions, because they don't really do that. They might have some, but probably not as much as we want. And we've seen that small in value, especially US small cap value, when we put both together, have had historically sensational returns. So it's probably something we do want a fair amount of in our portfolios, especially when we're young. But robo-advisors won't let you. You can't call them up and say, hey, I want more of this and less of this. That's not how it works. They're the advisor. They make the decisions, right? So just be careful. Just because these things are on the computer and they're online and they have a fancy name, robo-advisor, whatever the hell that means, they're just selling you a product. And the product is a decent portfolio at a low cost. And there's nothing wrong with it, but let's not fall for the trap that it's like amazing, okay? Because it isn't. They're good. They're just not great. You know what? They're okay, but they're not great. Yeah. Okay. Next topic, RSP versus TFSA. Very common question. Which one is better? Which one should I use? Okay. Now, in class, I would take a long time to show you the math behind this. Today, for this purpose, because we're doing this over recording, I'm going to just get to the chase. And I've got something on OWL, which is called RRSP refund reinvestment.pdf. You can look on that and see some further examples of what I'm talking about here. Okay? All right. So here's the gist. Which one is better? The answer is it depends. Okay? The answer is it depends. Remember, for an RSP, okay, you get a tax deduction when you put the money in, and all the money withdrawn is taxable. So you get tax deduction when the money goes in, you pay tax when the money comes out. Okay? And inside, the money grows tax deferred while it's in the account. You don't pay any tax until the money comes out, and you can invest in pretty much anything you want. TFSAs, right? You do not get a tax deduction when you put the money in, but you pay no tax when you pull the money out. Now, when you hear that, TFSA sound amazing. They sound amazing. You're like, wait a minute, wait. If I put $1,000 into my TFSA and I buy a stock and that stock grows to $1 million, I never have to pay tax on that? Correct. But if I put $1,000 in my TFSA and it grows to $1 million, when I pull the $1 million out, I have to pay tax on it, right? Yes. And when you hear that, you think to yourself, the TFSA must be the clear winner. It absolutely must be, but it's actually really not that simple. Okay? So this gets a little tough to explain over a video, but I'm going to do my best, okay? The answer to which is better depends on tax rates. Okay, this is the secret. And in fairness, the answer is have both. Okay, everybody should have both. I have both, you'll have both, your parents should have both. We should always have both. But the academic answer depends on tax rates, okay? So here's the rule of thumb. If your tax rate in retirement will be lower than it is now, the RSP is better. But if your tax rate in retirement will be higher than it is now, your TFSA is better. Okay, that's the rule. And again, it's hard for me to prove that in great detail. You can look at the thing I put online. I'll run you through a quick example now. And I encourage you to Google away on this and find other examples. You can probably find YouTube videos and stuff that'll do more math for you. But this is the rule of thumb. Now, let's just think of it from the RSP perspective, because this will probably make sense before we start looking at numbers. You want to put money into your RSP if your tax rate is really high now, so you get a tax deduction at a really high rate. If your income is going to be lower in retirement, because then when the money comes out, it gets taxed at a low rate. Deduction at a high rate now, taxed at a low rate later. That should make sense. And if it's flipped, that you only get a little deduction now and a lot of tax later, the TFSA would have been the better choice. Okay, that's what this rule of thumb is telling us. So let me run through this example. Hopefully this works over video, and I apologize if this is hard to follow. I want you to pretend that you have a part-time side hustle on weekends. You are tutoring other university students, okay? And you make $5,000 in cash. Now, because this is business income, you have not paid tax on this money yet. It's not like a paycheck where they withhold tax. This is business income. You have to declare it on your tax return. So you have the entire $5,000 in your hand, okay? Now, you're trying to decide, should I put that $5,000 in my RSP or should I put it in my tax-free savings account? Okay, that's the answer we're going to try to come up with here. Your current tax rate is 30%. I just made that up. We're going to invest for 5 years. We're going to make exactly 10% a year, just for sake of example. And when we pull the money out in 5 years, your tax rate will also be 30%. So our tax rate is going to be exactly the same going in as it is coming out. Okay, so here we go. Let's say we choose the RSP. Now remember, if you put the whole $5,000 in your RSP, you get a $5,000 tax deduction. So on your tax return, you would claim $5,000 in tutoring income and a $5,000 RSP deduction. So those two things net to zero, which means today you don't pay any tax on that. You don't pay any tax on that $5,000. So you can invest the entire $5,000 because you don't need to put any aside in taxes. You invest it for 5 years at 10% a year, and in 5 years it will grow to $8,052.55. Then at the end of the 5th year, you pull it all out for some reason. You withdraw the whole thing. Well, now the entire $8,052.55 is taxable income. You pay 30% in taxes, which means you are left with $5,636.79. If I lost you, rewind a bit and listen to that again. Okay? So that's option 1, RSP. Option 2, TFSA. You decide instead, no, I'm going to put money in my TFSA. That thing sounds incredible. Now, if you have $5,000 in business income and you want to put some of it in your TFSA, you have to remember you're going to pay tax on that $5,000 because now we don't have the RSP deduction to offset it. So you say to yourself, I made $5,000, I pay 30% in tax, so I'm only going to be able to invest $3,500 because I have to withhold $1,500 in tax, right? Because $5,000 in income times 30% taxes means you're going to have to send the government $1,500. So you only have $3,500 left to put in your TFSA. So you do. You put $3,500 in for 5 years at 10% a year, and it grows to $5,636.79. Now, at the end of 5 years, you pull all of that out of your TFSA, but you don't have to pay tax because all the money coming out of your TFSA is tax-free. So you get to keep the entire $5,636.79. In both cases, you end up with the exact same amount of money. So this mathematically shows you that if your tax rate when you put money into these accounts is exactly the same as when you pull it out, it really doesn't matter which one you used. And the government knows this, okay? And if you think about it, the TFSA sounds so incredible, and it is incredible. But if it was so much better than the RSP, and the government was going to lose so much money in taxes, they would never have invented the tax-free savings account. But they know at the end of the day, if tax rates stay the same, there really is no difference. There's no difference to you. There's no difference to the government. Everybody's going to be in about the same position, okay? Just take my word for it. You can see the math there anyway. But if you redo the math and you pick a lower tax rate money going in and a higher tax rate money coming out, you will find out that the TFSA is way better. And then if you flip it and have a very high tax rate when the money goes in and a very low tax rate when the money comes out, the RRSP will be better. Okay, so that's the golden rule. So, oh yeah, I forgot I actually put this in here. Here's a little online calculator, which I'm not gonna show you now, but if you can't conceptualize in your mind why the difference in tax rates changes, play around in this calculator. It's really cool. I found it online just the other day. I forgot that I had it in here. What you want to do is open up this calculator and change the income when you contribute and the income when you withdraw. Make one higher and the other lower, and then the other one higher and the other one lower. And by changing the amount of income, it'll change your effective tax rates. And you can see it'll calculate right there for you which one you have more wealth with, the RSP or TFSA. This is a really cool calculator, so spend some time playing around on that. So here's the problem though. Even though the rule is sound, right? The rule, if I have higher taxes now and lower taxes later, RSP is best. If I have lower taxes now and higher taxes later, TFSA is best. The problem is, who the heck knows what your tax rates are going to be 40 years from now? And that's the problem. Okay? Because in order to know what the tax rates are going to be 40 years from now, you first have to know, well, what the heck's my income going to be in retirement? Now, I can help you with that one. If you guys do what I've been teaching in this course, pay off your debt, establish an emergency fund, and then invest every month for the rest of your life, you are going to be rich. You're going to be rich and have so much money in investments that your income will probably be at least the same or maybe even higher in retirement. How cool is that? Okay, so we can usually figure that our income is going to be the same or higher, which is amazing. Most people assume their income will be less in retirement because most people don't invest very much, and they don't invest long enough, and they don't invest well, and they have too many stupid bonds in their portfolio, and they use mutual funds and stuff like that. So their income is lower in retirement because they didn't grow their wealth that much. But you guys should have a lot, right? You're going to invest early, 100% stocks, no bonds, use ETF, save on fees, have millions. So from an income standpoint, we can probably feel pretty confident that our income is going to be the same or higher in retirement, which is amazing. But who the heck knows what the tax brackets and tax rates are going to look like 45 years from now? Nobody. Who knows? Whatever the government feels like. There could be one tax rate in 45 years, or there could be 27. I don't know what the laws are going to say. And what are the tax rates going to be? Higher? Lower? I don't know. Do you know once in the US, the highest marginal tax rate was something like 70, 80, or 90%, something bonkers like that? Could Canada do that? Yeah, maybe. So who knows, right? So even though we know what the rule is about when an RSP is better and a TFSA is better, we have no idea what the tax rates are going to be. So because of that, we can use a rule of thumb, but we never know for sure, which is why you should have both accounts. So what's the rule of thumb? This is just a general rule of thumb. You can decide what you want to do with it. When you're in the first tax bracket, meaning the lowest tax bracket, and your income's low, definitely use your TFSA first and your RSP second. For sure. Because when you're in the lowest tax bracket, you have to assume your taxes are going to be higher down the road in retirement than it is now, right? When your income moves into the third bracket and above, probably makes sense to use your RSP first and your TFSA second. Okay? What do you do in the second tax bracket? I don't know. It's hard to say because now we're really guessing as to what your income is going to be in retirement. I don't know. I got to be honest. I think I would do this in the first and second bracket and this in the third and higher. Okay? Probably. And listen, nothing's going to be a bad choice. TFSA is great, RSP is great. It's just, something like this rule of thumb would be good. Now notice, if you happen to have enough money when you're in the lowest bracket, like say your parents give you money or your grandma gives you money or whatever the case may be, there's nothing to stop you from putting money into an RSP once you've maxed out your TFSA. But just defer using the tax deduction to a future year when your income's higher. You get a tax deduction for putting money in your RSP, but you don't have to take it right away. you can defer using that deduction 1 year, 5 years, 50 years, whatever you want. Okay? All right. Okay. Now, here's a cool little trick though. Here's a cool little trick. Something that's great about RSPs that for many of you guys, you're going to be able to use this trick at some point in your life because many of you are going to be very high income earners and you're going to be getting a salary. Many of you are going to go start businesses, so this doesn't really apply to you. But for the high income employees that are listening to this, one day when you're making a bunch of money, here's a little trick that can make your RSP extra special. Okay? Now, in the previous example we did, I said you got $5,000 from tutoring, okay, which meant you hadn't paid tax on it. The truth is, most people in their sort of 40s and 50s and whatever don't usually have a ton of side hustle income because they're raising kids and stuff. I used to have a lot of side hustle income, and I don't anymore because raising my kids is my side hustle. So most people who put money in their RSP get that money from their paychecks, right? You get your paycheck deposited into your bank account, and you take a little bit of it and you put it in your RSP or your TFSA, right? Now, your paycheck money has already had tax taken out, right? Because your employer has to withhold taxes on your paycheck. So what does that mean? It means that when you save up $5,000 from your paychecks and you contribute it to your RSP, you're going to get a tax refund. You're going to get back the taxes that were withheld on that $5,000. That's why one of the things that makes RSPs great is they generate tax refunds. And they generate them at your highest marginal rate, right? It's a fantastic deduction. So if your marginal tax rate was 30% and you put in $5,000 from your paycheck, you're going to get a tax refund of $1,500. Amazing. Okay? Now, I think I said in class before that most people in Canada that work and make decent income usually get tax refunds. Why? Because they invest something in their RSPs, and a lot of people have childcare expenses too. So tax refunds are a pretty common occurrence in Canada, at least among people that make reasonable incomes, and you, of course, will be in that category. So you should expect, for 2 or 3 decades of your life to be getting tax refunds on a consistent basis. So what you can do is be different than everybody else, because most people get a tax refund and they're like, woohoo, free money, and they're going on vacations, upgrading their car, I don't know, spending it on whatever. So you could do that. Or you could take your refunds and as soon as you get it, immediately reinvest it back into your RSP. Immediately reinvest it back into your RSP. And that's what my wife and I do. When we get our tax refunds in like April or May, as soon as the money goes into our bank account, without hesitation, I put it into our RSPs and TFSAs because we want to try to max all of those accounts out every single year. Okay, that's our goal. So if you do that, in this example, you put in 5, you get a $1,500 refund, you immediately put this into your RSP, which means now you've effectively contributed $6,500. $5,000 was yours, $1,500 was a tax refund, now you've got $6,500 in your RSP. You can't do that with the TFSA. You can't do that with the TFSA because the TFSA doesn't generate a tax refund. Okay? So putting your $6,500 in your RSP will always be better than putting $5,000 into your TFSA, or if it's self-employment income, it would only be $35. No, forget. I totally take that back. I'm tired. Ignore that. Sorry. Okay, so it's a bit of an unfair comparison, but it's a neat trick. Okay, so it's not an Excel file, it's a PDF, that same PDF file I just talked about, which is called RSP Refund Reinvestment. If you scroll down to the 3rd page on it, I've got a little chart, which I'll talk about here, and you can just read it. In year 1, you put $5,000 in your RSP, and you plan on putting $5,000 in every year of your money out of your paycheck. But in year 2, you get a tax refund, and you take that tax refund and you slam it into your RSP. And you know what the tax refund you put in your RSP generates? Another tax refund next year. And you take that tax refund and you put that in, and that generates another tax refund. And this unbelievable snowball starts happening in your RSP. So check out the little graph, you'll see what I'm talking about, and it gets fun. And basically what it means is you can start using tax refunds to fill up your RSPs instead of always using your money. It's a neat little trick. Okay, enough about that. So use both throughout your life. They're both excellent. And listen, a lot of you guys are going to have more than enough money that at some point in your life you will max all of them out, and that's great. So just keep doing it, okay? Now, this is fun to show in class. I'm aware this is getting long, but I'm going to tell you because it's a neat little thing you can show your parents. In Canada, depending how long you've lived in Canada, you're entitled to something called old age security, and you'll read about it in your textbook, assuming you're still reading your textbook. Okay. The amount you receive depends on how long you've been in Canada after the age of 18. It's not much. Okay. The maximum amount per year in 2020 is this much, $7,362. That's not much. You're not going far in that amount of money. But if you look at the name, it's old age security. It's supposed to just give you a little extra just to make sure you're okay. You're not going to starve. You can pay your hydro bill, stuff like that. Okay. So it's not supposed to be a main source of income in retirement. It's just a little bit extra to help. Now, here's the thing. This old age security is means tested, which means you get it as long as you make a little bit of money or a medium amount of money. But once you start making a lot of money in retirement, they don't give it to you because it's a security check for those who need it. And if you're making lots of money in retirement, the government's like, you don't need this. So they don't give it to you, and they save that money to give it to other people, right? So we call this clawback, which means they will say to you, well, you're entitled to this much a month, but once your income rises to a certain level, we're going to reduce or claw back how much of this pension you actually get every month. So here's the formula. The clawback is equal to 15% of your income between these two amounts. So as soon as you make over $75,910, every extra dollar you make, you lose 15 cents of old age security. And once you get up to this upper bracket, you will receive no old age security because you probably shouldn't need it. Okay? So what can we do using the RSP and TFSAs if we don't want to lose our old age security? Okay, and this is the thing you might want to show your parents. I'm going to flip over to this. Okay, that was the lower bracket before you start hitting the clawback. Okay, every dollar after this, you lose 15 cents of old age security. So let's say you get your old age security, $6,900, and you get $12,000 in Canada Pension Plan. Okay, so now we're up to $18,900. Yes, I'm literally getting a calculator out if you can hear me pushing buttons. And let's say then you take another $57,010 out of your RRSP, okay, which of course is taxable income. So now your total income for the year is right at the threshold where you're about to start facing clawback on this old age security, which is sort of like an extra 15% tax if you think of it that way. So at this point, if you stopped and you didn't make one extra dollar, you don't lose any of your old age security. You get to keep it all. But what if you want more money? What if you're like, well, I can pay my bills in $75,910 and I'm eating and I get to go to a restaurant once in a while and life's okay. But boy, I would like an extra 25 grand. To put me at about $100,000 a year income. So I can start taking vacations and I can lease a fancy car because I deserve it. I can't spell, it's late, lease a car, whatever. You want an extra 25 grand. Because hey, you're retired, let's enjoy life. But the problem is, if you take this money out of your RSP, now your income is too high and you're going to start having to pay back old age security. So all you do then is take this money out of your TFSA. Because money that comes out of your TFSA is not taxable income and will not trigger old age security clawback. Okay? So between you and your spouse, if you're each getting old age security, try to cap your taxable income right around 75,000 if you can, to limit the clawback and get your extra income from your TFSA, and that way you won't face clawback. Okay, so neat little trick. All right. Now, final thing about the difference between TFSA and RSPs. One thing you can do to use TFSAs to your advantage, or at least another thing you can do, is when you're picking your asset classes, remember that? Small, medium, large, geography, growth and value and stuff. Let's put the things that we think will go up in value the most in our TFSA. So small cap value, let's put it in our TFSA, small cap growth, and maybe emerging markets, depending how you feel about that. Why? Because those things probably have the best chance of going up the most. And heck, if we never have to pay tax on the things that go up the most, why don't we go ahead and put those in our TFSA? Now, we can't put very much money in our TFSA. It's only $6,000 a year. You can put way more in your RSP. So you probably can't put all three of these things in your TFSA. But listen, if you can just get your small cap value in your TFSA and everything else goes in your RSP, that's probably a good decision. All right. Okay, foreign exchange. Another big topic that I'll try to do quick. One of the problems with investing in all the different asset classes that we're talking about is, at least as of today, you have to expose yourself to foreign currency fluctuations to do it. So I want you to use exchange traded funds that buy indexes of certain asset classes. So I want you to buy a U.S. small cap value index fund, a U.S. small cap growth index fund, an S&P 500 index fund, and so forth. Because Canada is such a teeny tiny financial market, we can buy some of those investments where those investments will eliminate the volatility between the Canadian dollar and US dollar exchange rate. But most of the investments we have to buy in US dollars on the American stock exchanges. And when we do that, not only are we taking a roller coaster ride because of the stock market, we're taking a roller coaster ride because of exchange rates between Canada and the US. It's really unfortunate, but it is what it is. There's not much we can do about it now. If you don't want to buy any investments in US dollars in the US, you don't have to, but now you're extremely limiting the investments you can actually buy because there's not many Canadian dollar hedged investments available to us. There may be over the next 10 years or so, so keep your eye out, but for now, there's really not that much. Okay, so what does that mean? It means in some years, like right now, when the Canadian dollar is going down, all your US investments become worth more to you because if you shaded them into Canadian dollars, you'd have way more Canadian dollars. And in the years when the Canadian dollar is strengthening, you would have less Canadian dollars. So sometimes the change in exchange rate works in your favor, and sometimes it doesn't. So what do we do about that? Okay. Oh, here I looked historically in 2012, 13, 14, 15, 16, and 19, our US denominated investments did better because they were worth more Canadian dollars because the Canadian dollar was weakening in those years. And in 2011, 17, and 18, the Canadian dollar was strengthening, so our portfolios did a little bit worse. Okay. So here's a graph of exchange rates. You can see it's volatile. It's volatile. Like that is a rocky roller coaster. And again, you either have to decide option A, I'm going to accept this extra volatility with the change in exchange rates, and in doing so, allow myself to buy the kind of investments I want, like US small cap value and so forth. Or option B, I don't want this kind of volatility, and I'm only going to buy the investments that I can on the Toronto Stock Exchange that eliminate this volatility because I'm buying in Canadian dollars. I have chosen to accept the foreign exchange volatility, and some years it's great and some years it isn't. Now, I normally like to try to show you, and you can see, some years it's great, some years it's bad, right? I normally like to try to show you historical research to try to tell you at least what we know historically to help make good decisions going forward. It's hard to find research on this because there's so many assumptions. When did you buy? What did you buy? What was the timing? When do you need to sell? It's really hard to know. It's really hard to know whether we're going to be better off or worse off exposing ourselves to foreign exchange risk. It's really hard to know. The research I've seen so far seems to indicate that over the long term, and again, you guys are going to be investing for decades, it probably actually won't make that much of a difference. Now we can see, even on this chart, there's a pretty swingy range, right, in the exchange rates. But historically speaking, the average is something like here, right? If we invert the exchange rates, we're usually looking at a Canadian dollar that's like 75 to 78 cents US. Sometimes it goes way, way lower. Sometimes it's gone way, way higher. But most of the time it comes back to around 75, 78 cents. So I don't know if that's true in the future. I honestly don't have a clue. But I'm willing to take that chance because I want to be able to buy all the investments I want to buy. And if I have to accept some foreign currency volatility, that's okay with me. It may not be okay with you, but it's a decision you have to make. Now, here's showing the results of two similar but somewhat different investments. So here's VTI. I showed you that last lecture. That's the Vanguard Total Stock Market Index ETF that buys the whole US market. Remember that one? Love this one. And here's VUS. This is the same investment, but it's in Canadian dollars and it hedges out the foreign exchange risk. Notice VTI has an MER of 0.04, VUS has an MER of 0.16. Why? Because the products that this ETF uses to eliminate the foreign exchange risk, their derivative products, cost money, so they have to charge you more to pay for that hedging. Okay, you can see that over the years their results are pretty similar, so you can get pretty similar results, at least using this investment, by hedging out the foreign exchange risk. So here's one example. If you want exposure to the entire US stock market, which is a really good thing, and I really think you should, and you don't want this kind of volatility, here's an ETF you can use. Okay, here's an ETF you can use. All right. Now, if you want to be a superstar, for those of you in the class that are super keener when it comes to investment, you may be able to take this kind of fluctuation and put it to your advantage. Okay, so when the dollars have the really huge swing between Canada and the US, switch back and forth between these two investments. Sometimes buy the one denominated in US dollars, and then when the dollar swings way hard back the other way, switch it and buy the one that's in Canadian dollars, and now you can actually capture additional profits. That's all I'm going to say about this for now because it's too hard to explain over this video. For those of you that know what I'm talking about, you're going to figure this out in a heartbeat, but do a little research. You can use these extreme changes. I wouldn't do it for like little changes, but the extreme changes, and switch back and forth between the US denominated investments and the Canadian dollar denominated investments and make some pretty serious extra profits. Okay, one last thing. I'm going to take a break and then I'm going to come back and do this last thing. Stay tuned.